Okay, the session is to discuss some important questions from the exam perspective. Generally, I'm taking some questions mostly which are towards a practical calculation aspect rather than taking questions on the theoretical way, just because the theory is very clear to you now since it's just 2 more days left before the exam. So I'll just take up some important questions, okay, which have been asked in the previous FRM exams also, okay. And the reason being simple is what happens is we always face a time crunch in our exam, so we tend to make a lot of mistakes which are very scoring, but we tend to make mistakes and we lose marks and we lose an attempt sometimes just because of some silly mistakes. So need to be very alert on what the question is asking, what is it telling to you to, what kind of important inputs are required from the question. This all needs to be very much taken care of when we are appearing for the exam. There can be a case where it is very difficult to understand a question and or to remember the formula. So in that case, you need to keep in mind that if you're not able to solve the questions, skip it. You can come to it later on. Somehow, if you're very lucky or somehow your memory kicks at that time, you'll be able to solve that question. So keep in mind, if you're not able to solve a question, skip it, because you have a number of questions to solve in the 4 hours. So, and keep yourself calm as possible. So let's start. Okay, I have some questions, taken some important questions where generally students make mistakes which are scoring, but students tend to make mistake. I'll just take up some the questions. You see here on the screen there is a question that says a portfolio has an average return of over the last year of 13.2. Benchmark has provided an average return of on over the same period of 12.3%. So the portfolio standard deviation is 15.3%, its beta is 1.15, its tracking error volatility is 6.5, semi-standard deviation is 9.4, lastly the risk-free rate is 4. So many values. Finally, what is it telling to calculate? Information ratio. The most important value is information ratio. So you have to first of all take into mind that what the question is telling you to calculate. So in this question, suppose it is telling to calculate the information ratio. First thing that should click to your mind is the formula of information ratio. Okay, so it is the average return on portfolio, okay, minus average return on benchmark, okay, divided by the tracking error or the standard deviation of E alpha. Okay, so what is it saying? So the average return over the last year of the portfolio was 13.2. It's 0.132 minus, what's the return on benchmark? 0.123 upon the tracking error. You have to find the tracking error. It's 0.065. You get the answer. Okay. Now, question is very simple. The problem is n number of values given, the portfolio standard deviation, beta, semi-standard deviation. Are they relevant? Are they important? They're not, but it's just to distract you. It's just to confuse on the formula. They're giving you standard deviation. They're giving you semi-standard deviation so that you make a confusion between Sortino ratio or the Jensen alpha or is the Sharp ratio. So n number of values given just to confuse you along with the returns. Finally, you have to keep in mind what is the question telling you to calculate. So the answer is very simple. I'll just scroll down with the solution. We are not here to actually solve the questions. It's just for your understanding of what mistakes we tend to make. So I think everybody knows the information ratio. The problem is that in the crunch time, you tend to make mistakes, and that's what you have to avoid for a very simplistic scoring question. Okay. So we get the answer as 0.138. Okay, I hope let's move on, and the message is very clear with this question what actually we should focus when we are in the exam. Okay, Okay, let's look at another question. Okay, Albert Franklin. So another important question from the exam perspective. Also, it has been asked in some previous exam. Okay, and anyways, as I told you, I'm looking some at calculative questions where we tend to make mistakes. Theory is very clear in my mind. Just 2 days before the exam, much of the concepts are very clear. It's only the mistakes which we make, and some important questions where we can score and can clear up the exam. So you see that Albert Franklin wants to estimate the market risk premium. It's clearly in the question. Initially, it's mentioned. They want to estimate the market risk premium. In the previous question, it was mentioned at the last. It told you n number of values, and at the end of the question, they tell you that you have to calculate the information ratio. Here, initially, they tell you that wants to estimate the market risk premium for the stock of Allen's Pipes Company. He gathers the following information: the expected return for Allen, the risk-free rate, beta Allen. Okay, so I think it's very simple. Okay, so it's to calculate. Take it this way: it's expected return on the market. Okay, risk-free rate plus beta into return on market minus risk-free rate. What is this? The market risk premium. That's our understanding. We have the expected return on this stock is 10.75%. We have the risk-free rate 6%. Okay. We have the beta. Okay. That is 0.6 into the market risk premium, which is the question is telling you to calculate. It's just substituting the values and you have the answer. Okay. This way we easily get the answer, but just putting values. Fair. So answer comes to 7.92%, which is closest to 8%. So the answer is C. Fair. They have the solution. Okay, that's what I tried. It's just this market risk premium which we needed to calculate, and we tend to get confused with n number of terms at the crunch time. It's the market risk premium. So you have to be very clear with the concepts, very clear with the formulas. Again, at the end of the session, I'll give you the links where you can download some important formulas. Okay, the formula sheet. It's free for you students. It's a free download. Just go ahead, revise some important concepts, revise some important assumptions, revise some important to know things before the exam. Okay, give you that links at the end of the session. Okay, where you have some important formulas. Okay, it's a formula sheet. Okay, so that will be available at the end of the session. Okay, EWMA is very frequently asked question, very important concept from the exam perspective. You will surely see a question on EWMA. Okay, so in this case, and you see this question. Okay, there's an investment banks which uses the EWMA. Why EWMA is used? To estimate the future volatility. Okay. Try to take out the figures which the question so that we don't get confused. They say they use a lambda of 0.9. Okay, the current estimate of daily volatility is 1.5%, so we have the volatility, okay, as 1.5%. Okay, the closing price of the security is 20 yesterday and 18 today. Okay, using the continuously compounded return, what is the updated estimated volatility? So this questions tell you to estimate the next day volatility. We know the EWMA formula. Okay, it's variance of t plus 1 is equal to lambda into variance of t plus 1 minus lambda of squared returns, okay, of the previous day. Now what happens is you need the square returns. Here using the continuously compounded returns. So we want the continuously compounded returns. How we do that? Okay. The closing of the price of the security was 20. Okay. and the price of today is 18. So this way you get the returns. Okay, but they want it continuous. So we take a log normal of this. What we get? We get it. If you take out the log normal, what is the value you get after this? You get a value of 10.53%. Okay. I think this is very clear to everybody. Any doubts out here? I hope not, because we are, this is a very simple concept. We want the continuous compounded returns. Still we have our discussion forums where we can discuss this in more detail. Let's continue with our webinar. You have the discussion forums. You can post any of the queries there through your account. Okay. It's a forums where you can visit and do this. Okay. I'll just continue with the example. It says 10.53% as the daily returns. We just need to, what is now? It is very simple. It is just inputting this values, just substituting the values. So it says variance of t. Where do we find variance of t? It is this 1.5%. But this is, keep in mind, it is the daily volatility. So you have to square it. Okay, the 1.5%, the whole square. Keep this thing in mind. You will surely tend to make a mistake in exam in hurry, and you tend to lose marks on this. So keep this point in mind. Okay, so it is 0.9 into 1.5 the whole square root. 1 minus lambda, it is 0.1. Okay, into 10.53, it is a negative 10.5. Keep in mind there is a negative return. Okay, but we square it, we get positive returns. Okay, 10.53%. We get the variance value through this. What is the variance value? You tend to get some value out of this. Okay, now since we want the volatility, okay, the final volatility, I'll not get into calculation of this. Okay, this is very simple. Since we want the volatility, what we do is we have to square it, since this is the variance. Okay, and we need the volatility, so we need to square it. Keep in mind what the question is asking. It is telling you to estimate the volatility. If it just told you to get the variance, you don't need to square it, and you have the values out here. So keep in mind what the question is asking. Try to just be with the question. Don't get distracted with a number of values. What the question is asking, just keep in mind. So I'll just turn to the solution now, and you will see. Okay, you see some of the incorrect options also, what it gives you the message. Okay, forget to square the volatility terms. That's the problem. We need to square the volatility terms. We didn't. Forget to square the volatility term. Take to square root of the resulting variance. Okay, so these are some of the important points you have to give, just because you will surely have an option for a mistake you do some other way. So you know the formula. The problem is what mistakes you tend to make just when the scoring is so simple for question. It's a very simple question and scoring is very easy in this, but you tend to make a mistake. Okay, I'll just move ahead with the next example. Okay, the following model is used to estimate the daily return variance of an asset. Suppose the estimate of the volatility is 5% and the asset return is minus. What is the estimate of long run average volatility? Okay, it's a GARCH model. So you know the GARCH model. What is it? It is estimating the future volatility, but it has one more factor in this. Okay, it's a long run average volatility. So we don't need to get into depth of the question since it is telling you to estimate the long run average volatility. Don't get into the question where it is telling you to estimate each and every step of how they actually came to a GARCH model. So don't start writing the formula, okay, into into the like the gamma into the long run average variance plus the beta. You don't need all this. You don't just need all this. The simple way the question is asking you to estimate the long run average volatility. So what is it? It is very simple. Since it is telling you to estimate the volatility, it is omega, okay, into gamma, okay, into long run average volatility. Okay, so we have the omega value with us. Okay, do we have the gamma value? No, we don't have, but we can estimate. How's the gamma value estimated? It's 1 minus alpha minus beta. We have the alpha value 0.05 minus 0.92. This gives us 0.03 the weightage. Okay, gamma is 0.03 into the long run average variance. Okay, so what we have now is just taking out the long run average volatility variance. This value comes to 0.000167. Okay, just square root it, since it's again telling you to estimate the long run average volatility in this case. Okay, so we get an answer of 1.29%. It's very simple, but the problem is what mistakes we tend to make. Just keep calm and you'll be easily able to solve this kind of questions. The problem is they tend to make you distractive in this kind of questions where there is long run average volatility, but you attend with only variance, and somehow they'll give you values out here uh, just where you forget to take the square root as mentioned in the previous question of EWMA. So keep these kind of things in mind. Okay, any doubts? I'll try to take it at the end of the session. Okay, and you still have our discussion forums where you can post your queries. That should be very helpful for you. Okay, okay. Let's move to another question. So consider an equity portfolio with a market value of 100 million and a beta of 1.5 with respect to S&P 500 index. The current S&P index level is 1000. Each future contract is for delivery of 250 times index. Just try to take all these values with you, okay, so that you don't give a mix up of all this values in when you're trying to calculate a question in your exam, because as I said, the crunch time you tend to make mistakes, and somehow some of the values will not be, you can make a mistake. Suppose like 250 times or the index level, you may don't see and you take the 500 value. It's just a panic, nothing else. Okay, and we generally tend to make mistake in some easy questions just because we think that is manageable and just move as early as possible. Okay, so now the question is asking which following strategy will reduce the beta of the equity portfolio to 0.8. It's clear a question of the hedging way, or I should say that it is trying to reduce the beta of the portfolio. So we need to estimate through the options we see that we need to estimate the number of future contracts. Okay, we need to estimate the number of contracts. So how we can do that? If you remember the formula, which I think everybody does, it's not the day, it is number of contracts, okay, into beta, uh, the target beta I should say, okay, and the actual beta, fair, into size of the spot position, that is 100 million, okay, upon size of one future contract, that is in values, it is the index level is 1000, okay, and the multiplier is 250. That gives you the value of the contract. Okay, now it is the target beta is 0.8. The actual beta is what? 1.5 into 100 million into the contract value gives you. Okay, so what it tends to be, it's a minus zero point 0.7 into this value. So what you net you get is minus 280 contracts. What does this minus sign indicate? It indicates that you need to be short. Why? It's the simple reason is it is telling you to reduce beta. You are long and you need to reduce the beta. You need to reduce exposure. So it's simple that you need to be short. Okay, so you can eliminate these two options so easily, A and C, and you're left with only two options, B and D. Okay, I hope this all makes sense, and you need to be very alert on this. You sometimes what happens is we tend to just ignore the negative sign, and we tend to take the option C in that case, get long on 280 contracts, which is not the correct answer. Okay, these are some of the mistakes you can make it an exam. Okay, you have the solution, just go through it fast. I'll just move ahead now. Okay, so there is an investor who enters in a short position in a gold futures contract at USD 295.2. Each future contract controls 100 ounces. The initial margin is $3,200 and the maintenance margin is $2,900. At the end of the day, the future price drops to 286.6. Okay, which of the following amount is a variation margin? Okay, so we have to calculate the variation margin. Okay, so how we do that? We know we have to first estimate the losses the investor has made. Okay, do you think he has made any losses? Not really, because he's short the contract. Okay, and the prices have dropped. Fair. So margin account is being credited with some more amount instead of just he tend to paying it, he receives some amount. So be very clear, be very alert in this kind of questions. It is telling a variation margin, but there is no need, because you tend to ignore sometimes this kind of thing, that is what kind of position is he holding, and you tend to make this kind of mistakes. I'll quickly show you the solution also for this. You don't need to calculate still. There's a calculation shown for you. Okay, so the option 760 was given in there. Okay, it was given there. I am very sure you guys will not make this kind of mistake of using the $760 also. Okay, so just keep in mind what the question is asking, what the information is given. Try to read the question as early as possible and revisit it again if you have any doubts. Try to extract as much as information in the first reading. I'll just move ahead. Okay, there is one question out here. Okay, looks very lengthy question. Takes a lot of time of yours. How you solve it? Okay, first of all, read it fast. Alan has bought a futures contract on commodity at the New York Commodity Exchange on June for the future price. The first thing you know to know is he has bought a futures contract. Okay, the future price was 500 USD per unit and the contract was 100 units per contract. And then sets a margin account with initial margin of $2,000. So his initial margin is 2,000 US dollars. Okay, and the maintenance margin is 1,000 US dollars. Okay. Okay, the future price of the commodity varies as shown below. Okay, we have been provided with the variations. Okay, in the stock price, what was the balance in Allen's margin account at the end of June 5? Okay, so what best we can do is, just to be on a safer side, we can make a table. We can make a table and we'll start putting the values. Okay, so I'll take it this way. What's the day? Okay, the future price. Okay, daily gain loss, This you must have studied, but quickly you have to be very quick in the exam. The cumulative gain loss, okay, margin account balance, okay, and at what price will he get a margin call, okay. So it is June 1, 2, 3, 4, 5, and the question is telling you, hey, what was the balance in Alan's margin account so we have to find the margin account balance at this day, the fifth day, okay. So if we quickly note down the values, we don't even, when you're an exam, you don't even need this, but I'm doing it for your comfort here, okay, because since you're doing it on your paper, okay, it's 492.70, it's 484.2, okay, it's 471.7, and finally we have 468.8, okay. Okay, so now he's long the contract. There's a fall in price. What's the fall in price from his price? Okay, it is 500 minus 497.3. Okay, so he has lost $2.7. His contract size is 100. Okay, so it makes a daily loss of 270. Okay, the next day. Okay, I'll just fill this. The cumulative balance is 270 for the first day. Okay, the margin account balance, it was 2000. It is now being reduced by 270. Okay, 1730. Does he get some margin call? No, because the maintenance margin is 1000. He gets a margin call only when the price reduces, when the margin account balance reduces by below 1000. So similar way, the second day he sees that the prices drop again, so he gets a daily gain loss. It's a loss again from the previous dates of $460 loss. Okay, the total loss now is 730. Okay, now his margin balance gets reduced by this amount again for the day, that is 460. So it is 1270 now. Okay, similarly, he sees third day again the prices are dropping. This time it's dropping in at a much larger scale. Okay, it's 850. Okay, to the previous days the losses have been 850. The cumulative, it's now 1580. Okay, so now his margin account balance is 420. He needs to deposit in the margin account the cumulative cash balance of 1580 just to get it to 2000. Why he needs to do that? Because the account has fallen below the maintenance margin. Fair? Similarly, the next day he comes, he sees there is another drop in price. There is no recovery. So he sees he lost another 1250 for the day. There's a cumulative loss again of 2830. Okay. His margin balance account reduces to 750. Another time this margin account balance has fall below the maintenance margin, so he needs to deposit 1250 to get it back. Why? Because he actually filled it to 2000. Then there was another day with a loss of $1250, so he need to deposit that $1250 to get it back to the initial margin account. What happens is, next day he sees that there is another loss from the PSA, so he gets a loss of $290 for the day. Okay, the cumulative losses have been now 3120. Okay, so his maintenance margin balance account is 1710. That's the answer we wanted. This can be quickly calculated. Okay, you have to be very quick on this. Okay, it's a time consuming, but if you keep some patience, if you work a fast math, you'll be able to get this answer. Okay, if you use your calculators less and more of your own calculations, maybe you can get answers very quickly. So the answer is D, 1710. I hope this was very clear. Try to make a table, try to get all the information, try to what exactly the question is asking, and this way you'll easily able to solve this kind of questions. Even if one question is taking time, can be another question which is less time consuming, especially in the theoretical questions. Okay, now you see the similar table here. Okay, okay, this is very important question. Okay, another time consuming question. You see that this question is on currency swap. You see here. Okay, the US interest rate is 4% per annum, and the Australian dollar interest rate is assume that the term structure of interest is flattened in US and Australia. That means that the interest rates are now will be same for the coming 3 years. Assume the current value of Australian dollar to be 0.91 USD. Okay, there's a company ABC under the terms of swap agreement pays 7% per annum in Australian dollar and receives 3% in US dollar. So what is it doing? What the company is doing? It is paying you Australian dollar interest and it is receiving US dollar interest. Okay, so the company is long on US dollars, okay, and short on Australian dollars. Okay, the principal in the US is 10 million USD, and that in Australian dollars it is 11 million USD. Payments are exchanged each year and the swap will last for 3 more years. What you need to do is determine the value of the swap assuming continuous compounding in all interest rates. Okay, so you see that the US interest rate is 4%. You just quickly write it down. The US interest rate is 4%. Australian dollar interest 7%. Mind you, this is annual rates. Okay, okay, that gives 1 Australian dollar can buy 0.91 USD. Okay, company ABC and the pays. Okay, what ABC does is pays 7%. Okay, on AUD. Okay, and receives 3% on USD. Very clear? Okay, the principal, just write down the principal as early. Okay, the principal is 10 million. Okay, and Australian dollar is 11 million. Looks too cumbersome. Okay, let's make it more simple. I've prepared a table for you. You just have a look at it and see what simplistic use does. Before that, just see the payments are exchanged each year and the swap will last 3 more years. Determine the value of the swap assuming continuous compounding in all interest rates. So see that it says that you have to use continuous compounding. Since it's annual compounding, you have to convert it to continuous compounding. You know the formula how to convert it, okay, and discount that. I made a table for you. Just have a look at it, and I don't think so I need to explain in much detail this. Okay, so what happens is just see, okay, the tenure of the swap. It's the time of the swap. Okay, this first year, second year, third year. The company for ABC, the cash flow was 0.3 million. Okay, for all the 3 years, that is the interest it receives, and the principal it exchanged initially is getting paid at the end of the swap. Okay, we take out the present value of these swaps using the USD and Australian interest rates given. If you see from the okay, if you see that the interest rates were given to us in the example, I'll just open that slide for you and you'll understand uh, that what were the interest rates. See, okay, so the USD interest rate is 4% per annum. Okay, and the Australian dollar interest rate is 6%, and we convert it into continuous compounding and we get the discounted cash flows. Fair? It's very simple. You convert into discounted cash flows. Okay, and you get the present values. So the present value in USD is 9.7 million USD, and in Australian dollar it is 11.294 Australian dollars. Now the value of the swap, for company ABC in this case will be 9.725 million 225 million minus 0.91 into 11.294, okay, which gives you an answer of minus 0.5488. Okay. Okay, I see there are a lot of queries coming in for questions. Thing is, since I told you you can post the questions, whatever queries on the forum of ours, whatever doubts you have, you can post it on our forum. And the questions, if you have doubts regarding these specific questions, you'll get the content of these questions specifically. I think you can download them. I'll provide you the download link, or we can mail it to you. Okay. So there are specific queries to these questions. I think we can take it up through forum, and you can have these questions. And if you're stuck anywhere, you post it, and we can solve it for you. Okay. So let's move to the next question. I also see there are some exam specific queries. I'll also take up that can be quickly answered. I'll take it at the end of the session. Let's complete this as early as possible. Okay. Okay. The portfolio has a current market value of 62,47,000 with a daily variance of 0.0002. Assuming there are 250 trading days in a year and the portfolio return follows a normal distribution, the estimate of annual VAR at 95% confidence level is closest to. You have to estimate the annual VAR. What you are supposed to do is you need to remember the formula for annual VAR in this case. Okay, or just the VAR. It is VAR is equal to this thing in the 95% on 1.65 into sigma. Okay, the portfolio value. Okay, so now we have all the values. 1.65 into that sigma is the daily variance. So what we have to do is just take the square root of this. Okay, square root of 0.0002. Okay, and that comes to 0.01414. Okay, into the portfolio value. Okay, now this is the daily VAR we get. Okay, after this multiplication. Okay, so what we need is the annual VAR. Okay, how annual VAR is calculated? This equation is multiplied by square root of 250. Okay, the 250 trading days, that's multiplied, and we get the annual VAR. So the annual VAR comes to 22,997,854. Okay, I'll just move ahead for the next example. Okay, I see a question where we are supposed to calculate the VAR using the historical data. We are also told to calculate the 90% confidence, the expected shortfall at the 90% confidence interval. It's very easy to calculate. The problem arrives, and the message I want to provide is sometimes the data is not arranged. You have to arrange the data in the ascending order. Okay. So keep in mind you arrange the data. Sometimes you will be just given the values. You have to take care that the data is arranged. Now this looks an arranged data. That's the lowest value to the highest value, so that you don't tend to make any mistakes in the exam. So keep in mind to take up the arrange the data. So when you see at the 10% confidence interval, okay, you need to calculate the VAR. So it is the third lowest observation of the list. Why? Because there are 10 or 30 observations, then at 90% of confidence, 10%. And so the third lowest observation is minus 10%. So VAR will be 10%. Expected shortfall is nothing but the average of the values that fall below VAR, and that is 16 plus 14 divided by 2. Okay, so you get a value of 15. So the expected shortfall is 15. The VAR is 10%. Just need to keep in mind the most important messages that arrange the data. They'll surely not give you arrange data because you're given a lot of time for the questions. Sometimes they do, sometimes they don't, depends, but you never take your chances. Okay, there's another question. It's very much intensive. It is very much calculative. So, and the question means everybody knows the formula. This formula is easy to remember. The problem is a lot of calculation is required. Okay, you see there is a portfolio that is composed of two securities and has the following characteristics. Investment security A, okay, that's 15,000. Okay, there's investment in security B, that is 30,000, and we are given the volatility. Okay, for both the securities we are given the correlation. Okay, now what we need to do is we have to calculate the VAR of the portfolio. How do we calculate the VAR of the portfolio? It's a very lengthy formula where you initially have to take out the weights. Okay, but we can make it simplistic. If you want to try the other option, we take out the VAR of portfolio A. Okay, how we do that? 1.65, that because we are told to calculate the 95% confidence interval. Okay, 1.65 into portfolio value. Okay, into volatility of portfolio. Okay, and we have VAR of B, that is 1.65 into 30 into 3%. I'll not get into detailed math of this and what are the values, but I can now, whatever values you get for this can be used to calculate the portfolio variety. So variance of A, the whole square, plus variance of B, the whole square, okay, plus 2 into variance of A into variance of B into correlation. Okay, that's how you can solve this instead of just putting each and individual weightage square, okay, into the standard deviation square. Don't get into this pain. Let's take a shortcut. Okay, calculate the variance and try to reduce the input values out here in the square root so that you don't tend to make a mistake of missing a term in the input values. Hope the message is clear. Still, if you have doubts, I'm telling you, you can raise them in forum. We can answer it. Okay. So here is the another way that how it is calculated, but I never like the way because it is very lengthy. It is, you tend to lose some of the values, you tend to miss some of the values, and you lose some important marks in this. Okay, I'll just take up a query. There is a question that please tell how to you calculated the VAR in the last sector. Okay, I'm just telling you there is another way to calculate this. There's a question from Abhinav. Uh, this is one of the way to calculate, and I think Abhinav, you must be very clear with this. Okay, but there is another way. You take out the individual VARs, okay, of in the portfolio. Okay, so you take out the VAR for A, the VAR for B. Okay, and later on, once you have the value VAR for A and VAR for B, it is VAR of A the whole square plus VAR of B the whole square, okay, plus 2 into correlation into VAR of A to VAR of B. You'll surely get this the same answer. Only thing is, what I'm trying to do is simplify by uh, the input values that are put. Okay, I hope I'm clear. Okay, your question is about the expected shortfall. That is, expected shortfall is nothing but the average of the values that fall below the VAR. Okay, so I'll just quickly go over to it, but it would be great, Abhinav, that we use forums for this. I'm just doing it just to make it quickly. Okay, so we have. I'll just show you. We estimated the VAR to be minus 10%. This is the third worst observation. Now the expected shortfall is the values that fall below the VAR. These are the two values that fall below the VAR. So we take the average of this. Since it's the expected shortfall, that's the average shortfall. Okay, let's move ahead quickly. Okay, we come to the last question. Okay, so there is a bond with a par value of 1,000 with maturity in 3 years that pays a coupon of 5%, so annually. So we know the cash flows also, the coupon. Okay, in the so take out the terms. Okay, 1 2 3, and so in the final year 3. Okay, we have 50 euros at the initial year, second year 50, third year, the third year 1,000. That's the principal being paid. So discount at the annual spot rates. Okay, so how we discount it? It is 50 divided by 1.06, since it's an annual coupon. Okay, raised to 1. 50 divided by 1.07 raised to whole square. Okay, now what message I want to give is, sometimes we tend to miss this kind of values. Okay, that we have to square this. We have to square 1.07 in the whole cube. Okay, and 1,000 divided by 1.07. These are minor mistakes, but you lose some very important points in your exam just because of this. So keep in mind the discount factors. You have to square them according to the end period mentioned. Please be very specific. Had it been semi-annually, then it would have been 0.5. It would have changed it to 1. Okay, it had been changed to 1.5 this way. So keep these kind of things in mind. This is very important from the example, and we do face a problem. Just don't get panicked. Just keep yourself calm. These questions are very easy to solve. It's not very difficult. How we think about FRM1 exam, it's not difficult. Just you have to be very calm. So I come to the end of the session. There is no need to everybody know the maths of how to calculate the bond value. Though it's only the message I wanted to give is what problem we face in the exam. I'm providing you with the solution. Okay. Okay, I see that I discussed that I promised you to pay, that I'll provide you with the formula sheets at the end of the session. Just note down these links. Okay, these links are very useful. You can take the formula sheets here. Note down the links in the next 1 minute. After that, I'll just take up your queries quickly. Okay, I see some generic queries from the exam perspective. Just note down this as fast as possible. There's a Facebook link, there's a Google Plus link, and you can use them for the formula sheets. You can take the cheat sheets from there. Okay, you will surely get this slide, whatever you want. I will provide you the slides also with the questions we have discussed today. Will surely be provided tomorrow to you. I hope now you have note down this link. I'll take up some queries. I see someone asking, all formulas in the formula sheet needed to be remembered. See, it is not from the perspective of trying to make you like learning means making up you to mug up the formula. It is just for your refreshment. Okay, you know the formulas, but somehow just to be double cross check it and to be sure on it, we provide you the formula sheet. You know the formulas. It is just for your reference. Just at the end of the exam, you don't need to take much stress. It is just remember the formulas from the exam perspective and keep yourself calm. It's called a formula cheat sheet, which is very important from the exam perspective. And you have to memorize the formulas. I think once you apply the logic, you don't even need to sometimes memorize the formulas. So it's not really that you have to remember each and every formula. There's a logic, but it's just for your refreshment. We are providing you with the formula sheet. Yes, the Z table or the F stat will be provided to you in the exam. To my knowledge, when I appeared for the exam, it was provided with the exam sheet itself, with the exam paper itself, and you will be provided with this sheet. Okay, Hemant, I'm not clear with your query. Let's say 60, 70 years. I'm not clear with your query. Can you retype it again? Okay, Fatima, the slides will be provided to you. Don't worry, I'll see some more queries. Yes, yes, there will be enough time to finish. You manage it well, you'll surely be able to finish it. Okay. Yeah. See the target score, Hemant, it is, I think if you have appeared for a mock test, okay, you see there is a quartile score. If not, we have a offering where you can take the mock test also, okay. But you have to rank in the quartiles. You have to be in the top quartiles as best you can, okay. So the result is a comparison of all the students appearing for the exam. Okay, I think I'm very clear on this. Okay. Okay. These some content queries, Keshav. I think how to compare it. We can all. It would be great if you can put it on the forum. I'm taking some general queries now. So it's great if you can put it on forum. There's no negative marking. There's surely no negative marking. Please try to attempt all the questions. Please do that. As I said, Keshav, you have to be ranked at all in the quartiles. It's a comparison result all over the globe, whoever appearing for FRM. So it is who the students who are appearing and how you are compared with other people and how you are ranked. That's the way it is. If you're really interested in this kind of scoring, I suggest you take up a mock test. Okay, and where you can actually get this kind of scorings, how and you get the exam feeling also. We have an offering where you can take up the mock test series from us. Okay. There's a protocol. That's the pencil marking. You can erase the option and you can re-mark the option again in the OMR sheet. Okay. Yes, 60, 70 would be okay. Seeing the difficulty of the question, 60, 70 should do, but there is no guarantee. If the question paper is easy, it can be tough. It can be 90% also. But I don't think so. You should look from this perspective of scoring each 60, 70%. You should try to attempt and try to correct each and every question. That should be a target. And the preparation you must have had, I don't think so that you should target 60, 70%, but a better percentage than that. That apart from formulas, there are many concepts to remember. We had a webinar on this. Okay, what we did is we have for all the 4 modules we made a summary. Okay, the summary can also be provided to you through links to all the attendees we had. We will mail you the concepts, okay, which are important from the exam perspective. You can surely go ahead and take this. Okay, I'll just take up some more. Okay, I see there is no sectional cutoff like CFA. It's a comparison result. Okay, it's a continuous 4-hour exam, Hemant. Whatever you want to eat, you can eat before or after the exam. Okay, so since you students must be like, you guys must be well prepared now. We have one of a offering which should be very helpful for you right now. That is the FRM mock test questions. Okay, to check your preparation level and give you, and which will provide you the result for both the mock test and you'll understand what kind of difficult questions can be asked. It's similar to question papers provided by the FRM Institute. Okay, we try to test you on that and we'll provide you with the results. You have another topic-wise quizzes also. You have discussion to the forums also. That's price is USD $60. Anybody interested, they can contact Austin at EduPristine.com. Just note down, it is Austin at EduPristine. I'll just mark it for you. Okay, whoever is interested can go ahead and contact on this email ID, that is Austin at EduPristine.com. Okay, so There is one question from Raj. This is the last question I'll take. Stress testing this metric is important. Yes, it is important. From the theoretical perspective, I don't think so. This metric is more towards EWMA model, and you'll be tested one question or two questions on it. EWMA GARCH model. Stress testing is something theoretical, which will be tested just because it is somewhere important from the FRM2 perspective. Okay, so uh, yeah, it's not that difficult. Okay, so if you really find that concepts difficult, you can we have another offering where you can get the concept recordings available to you, and you can clear your difficulties. Okay. Okay, so thanks for attending this webinar. Okay, you can post your queries regarding the content on our discussion forum, and if you have anything queries regarding EduPristine, okay, apart from content, you can post it. You can mail it to austin@edupristine.com, or you can visit our website edupristine.com/ca. Okay. Okay. Thank you. Thanks for attending this webinar. All the best for your exam.